And basically, this lecture is on the demand of certain students that they want to uh, discuss some of the important issues relating to financial reporting. As per your demand, I have structured today's lecture. So today's lecture will be focused on contemporary issues in financial reporting, which are related with the various aspects and which are some of the concepts in your syllabi also. So that we will be discussing. So I'll be taking your class for 2 hours today also, and same 2 hour tomorrow also, so that we can cover all this. So I will try to cover almost all the issues which were earlier in the short form in your syllabus, or uh, maybe in a very elaborative manner. So the basic issue that we will be discussing today is my screen is visible to all of you? No. Okay. So now you can off your videos. All of you can off your videos so that we can have the lecture directly. So the basic issue which we are going to discuss are relating to financial reporting practices, and basically these are the contemporary issues. First issue, which is very important from the financial reporting point of view, is the treatment of intangible assets. So as far as intangible assets are concerned, they are covered under International Accounting Standard 38. And International Accounting Standard 38 has outlined the various accounting requirements for intangible assets. Basically, what are the intangible assets? Intangible assets are those assets which are having without any physical substance, but they are identifiable. For example, goodwill is there, patent is there, trademark is there. Similarly, some kind of license is there, some kind of agreement is there, out of which you can derive certain benefits, and these kind of assets are separable, or these are arising from one kind of contractual agreement or some rights which are provided by the law to you, or arise out of the legal rights. So if intangible assets are meeting certain kind of relevant criteria which is outlined in the IAS 38, then we will be measuring such kind of assets and reporting that assets in the financial statements also. So this IAS 38 has given a criteria. First, you have to identify the intangible assets. If that particular asset fulfill that criteria, only then it will be treated as intangible assets, and whatever methodology for evaluation of such asset is given in the IAS 38, that will be followed. If a particular asset is covered under intangible assets as per the criteria laid down in the IAS 38, then initially we will be measuring that asset as cost. For example, if it is purchased in the first year, or if it is arised in the first year after putting in certain expenditure, it will be measured at cost. But in subsequent years, it will be measured at cost or using the revaluation model. So because we have a concept of fair value, so we will be using the revaluation method also. But in the initial year, we will be valuing that intangible asset at cost. But in subsequent year, it will be either cost or revaluation model. But if that particular asset has useful life, then that particular asset will be amortized over the year. That means every year some amount will be deducted from the value of the asset, and it will be shown in the statement of comprehensive income also, as well as in the statement of financial position also. But if a particular intangible asset do not have any finite life, that is life is infinite, then that is not amortized. It will not be amortized, only it will be shown in the financial statements. So as far as IAS 38 is concerned, that is particularly devoted towards the identification of the intangible asset, measurement of the intangible asset, recognition of the intangible asset, and finally the reporting of the intangible asset. But IAS 38 do not apply to certain kind of intangible assets for which other kind of international accounting standard or IFRS are available. For example, for recording the financial assets, we have IAS 32. For oil exploration and evaluation of assets, we have IFRS 6. Similarly, expenditure on the development and extraction of mineral, oil, natural gas, and similar resources, IFRS 6 will be applicable. And in case of insurance contract, insurance issued by the insurance companies, we will not be adopting the IAS 38. Similarly, intangible assets covered by another IFRS, such as which are held for sale or non-current asset held for sale or discontinued operation, for that we have IFRS 5. For deferred taxes, we have IAS 12. For income taxes, lease assets, IAS 17 is there. Employee benefits, IAS 19 is there. So for these kinds, so similarly for business combination goodwill, we have IFRS 3. So in these cases, IAS 38 will not be able to be applied because we have specific standard for these kind of assets. So this is the scope of the IAS 38 also. So IAS 38 will be applicable on all kind of intangible assets except financial assets covered under IAS 32. Similarly, assets covered under IFRS 6, it will not be applicable. Similarly, in case of IFRS 5, 12, 17, 19 and IFRS 3, this will not be applicable. Most important question is how to recognize an asset. There is a one very important recognition criteria which is laid down in the IAS 38 that require that if before recognizing any asset as an intangible asset, it may be purchased asset, it may be self-created asset, it will be recognized if and only if it meets certain criteria. Number one, first important aspect is, because when we define the term asset, we say that asset will be defined if some future economic benefits are going to arise from that particular asset. Same is the case with the goodwill. If it is probable that future economic benefits that are attributable to asset will flow in the entity. Secondly, cost of the asset can be measured reliably. Third, the requirement implies whether an intangible asset is externally acquired or generated internally. So this is the criteria which is given under IAS 38. So IAS 38 include additional recognition criteria also for internally generated asset. That means we have not purchased it, but the probability of future economic benefits must be based on reasonable and supported assumptions about the conditions that exist over the life of the asset. So if some patent is there and by using the formula we are going to arise some kind of benefits in the economic benefits form to the organization, only then that asset will be recognized as intangible asset, and it is probable. And probability recognition criteria is also considered to be satisfied for intangible assets that are acquired separately or in a business combination. So asset will be treated as recognized if and only if some economic benefits are going to arise in the future. Cost of the asset can be measured reliably, and economic benefits which are going to arise from that particular asset is going to be certain. Only then it will be recognized as asset. Otherwise, we will not recognize any kind of asset for which no future economic benefit is going to arise. So there are two methodologies to measure the value of the asset. First is initial measurement. Initially, when you purchase either asset or create that asset by putting certain expenditure, so they are always measured at cost. So whatever the cost you incur to purchase the, for example, if you buy a shop, the actual cost of the shop is 5 lakh only, but 7 lakh you pay as a pagdi, that is called a goodwill. So this is an intangible asset. So whatever amount you pay initially, that asset will be recognized at cost. So measurement subsequent to the acquisition, that means once you purchase it, after that every year you put some expenditure or its value increase or decrease according to the market situation. So we'll be following the cost model or revaluation model. So if you continue to spend something every year to improve your goodwill or improve the value of the intangible asset, then we will be following the cost model. Or otherwise, once you have purchased but its goodwill appreciate every year or the value appreciate every year or decrease every year, we will be following the revaluation model for that. So entity must choose either the cost model or the revenue model for each class of intangible assets. So there are a number of classes of the intangible assets. You can follow any kind of method, but depending upon the circumstances, you may follow cost model. So after initial recognition, intangible assets should be carried out at cost less accumulated amortization or impairment losses. For example, the value of the goodwill decreases, you will decrease their value, and whatever decrease is there, that will be charged to the statement of comprehensive income, and the value will be deducted from the statement of the financial positions. Second is revaluation model. So intangible asset may be carried out at a revalued amount based on fair value, because we have studied the concept of fair value, in which we said that every year we are going to revalue the asset on the basis of the criteria which is laid down in the fair value concept. So every year the value will be determined, but if any impairment has already been occurred or amortization of the value is already there, then we will decrease that value by determining the value from the active market. Such active markets are expected to be uncommon for intangible assets, so we will find out the value on the basis of certain parameters which are given in the fair value model. So under the revaluation model, revaluation increases are recognized in the comprehensive income. So it may be increase in the value because over the year, when the reputation of the business increase, goodwill value will also increase. So its value under revaluation model will increase. That will be treated as whatever increase is there, that is treated as income. But if it is decrease in the value, that will be treated as a comprehensive loss. So will be put in the revaluation surplus within equity. So whatever value is decreased, that is charged an expense over the year. So therefore, the amortized value will also be shown in the statement of comprehensive income as well as the statement of financial position as a decrease in the value of the asset. Second very important aspect, which is a contemporary also, because there are a number of institutions where contracts are taken. For example, you are a building construction company. So definitely there are a number of types of contracts which are taken, and construction contracts are common, and each contract has a separate kind of profit and loss account and statement of comprehensive income and statement of financial position, because we want to know what is the outcome of that particular contract. So for dealing that kind of situations, how to deal with the construction contracts, how to arrive at the revenue of construction contracts or the losses from the construction contracts or the payments for the construction contracts, IAS 11 provide the guidelines for that. So IAS 11 provide requirements on the allocation of the contract revenue and contract cost. So it will help you to find out what are the contract revenue from a particular construction contract and what are the contract costs to that particular contract, so that we can find out the profit or loss of that particular contract. So contract revenues and contract expenses are recognized by reference to the stage of completion. For example, if 25% of the contract is completed, we will recognize that 25% of the total cost of construction is recognized as the contract revenue, and 25% of the expenses are recognized as the expenses. So it is dependent upon the stage of the completion of the contract where the outcome of the construction contract can be estimated reliably. Otherwise, revenue is recognized only to the extent of recoverable contract cost incurred. So if whatever amount of contract cost has been incurred, only that portion will be treated as recognized. If it is not identifiable, the stage of completion, only at the 100% stage we are able to know that the contract is completed. So then accordingly, on the completion of the contract, you will be able to find out the profit or loss. Now, question before us is, what is construction contract? A construction contract is a contract specifically negotiated for a construction of an asset or a group of interrelated assets. For example, you may have seen large number of large size business buildings are constructed, large dams are constructed, long roads are constructed by the construction companies. So basically, for each kind of a project, for example, if you see on the Ludhiana, on the Firozpur Road, the bridges are going to be there. They are constructing the over bridges for moving from one place to another places. So this each kind of thing is known as a project. And for this particular project, a negotiation is done with the construction company and the agreement is entered into. So a construction contract is particularly basis an agreement which is enforceable law by law, and this is dealing with the completion of a particular project under the construction. That is known. It may be a single asset, it may be a group of asset which are interrelated to each other. So under IAS 11, if a contract cover two or more assets, the construction of each asset should be acquired separately if separate proposals are submitted. If separate proposals are submitted, separate account we will be maintaining, separate revenue, separate cost we will be calculating for each asset. And portion of the contract relating to each assets are negotiated separately. Cost and revenue of each assets can be measured. Otherwise, the construction should be accounted for in a entirely. So if it is not separable, there are a number of items which are covered in, but separate agreements are not there. That will be treated as one contract. So two or more contracts should be accounted for a single contract if they are negotiated together and work is related. For example, we are constructing in hospital, but along with the hospital, certain approach roads are there. Though you have made separate two contracts, but they are interrelated to each other. But you, at this juncture, if they are so interrelated that they can be treated as one project, then you can treat it as a single contract and a single set of accounting policies you can adopt. If a contract gives the customer an option to order one or more additional assets, construction of each additional asset should be accounted for as a separate contract if the additional asset differs significantly from the original asset or the price of the additional asset is separately negotiated. Sometimes when we make an agreement with the construction company that you have to create a hospital, but after some period of time you think that now one auditorium is also required for building a medical college, some classrooms are also required for building a medical college, then you will enter separate agreements for construction of each kind of asset and their accounts will be maintained separately. So this is one of the requirement of IAS 11, that how to deal with the single contract or with the multiple contract. If they are interrelated to each other, their negotiations are done jointly, then you can treat it one contract or one project. Accordingly, you can maintain your accounts. If it is separable, you have no interrelationship with these kind of activities, you can take it as separate contract. So what is included in the contract revenue and contract cost? Because when you enter into an agreement with another person, so contract revenue should include the amount agreed in the initial contract plus revenue from the alteration in the original work, plus claims and incentive payment that are expected to be collected and that can be measured reliably. So when an agreement is made, for example, the construction project of is going to be for 10 years, you started the work. Initially, you will agreed an amount that is called initial contract revenue. After that, you said now this thing also to be done, but for that you provide certain alteration in the original contract work and you maintain certain more claims also, plus claims. You may offer certain kind of incentive that if you complete this project before 3 months, this incentive is going to be there. So whatever is there, initial price, initial contract price, plus revenue from the alteration of the original work, plus any kind of claims and incentive which arise in the due course of time, that is also to be included in the contract revenue. But the situation is that it should be measured reliably. Second aspect is contract cost. It should include costs that relate directly to the specific contract, plus costs that are attributable to the contractor's general contracting activity to the extent that they are reasonably allocated to the contract, plus other costs that can be specifically changed to the customer under the terms of the contract. So if work is increased, accordingly the cost of building additional thing will also be included. This is regarding the contract revenue and contract cost. So for separate contract revenue and contract cost will be determined, and we will be arriving the profit on the basis of whatever the completion stage is there. So if it is 75%, we will find out the contract revenue for the initial plus whatever work alteration has been done, their completion stage, and add that value, and contract revenue will be there. Similar methodology will be followed for the contract cost. Now, how to account for that? If the outcome of construction contract can be estimated reliably, revenue and cost should be recognized in proportion of the stage of completion, as I have already told you. This is known as the percentage of completion method of accounting. To be able to estimate the outcome of the contract reliably, the entity must be able to make a real estimate, reliable estimate of the total contract revenue, the stage of completion, and the cost to complete the contract. So it is the on the obligation of the entity that they should be in a position to measure the outcome, the stage of the outcome, and then finally find out the cost, contract revenue, and contract cost. If the outcome cannot be estimated reliably, no profit should be recognized. This is absolutely stated in the IAS 11. Instead, contract revenue should be recognized only to the extent that contract costs incurred are expected to be recoverable, and contract costs should be expensed as incurred. So till the final revenue is received, you cannot measure the profit. The stage of completion of the contract can be determined in a variety of ways, including the proportion that contract costs incurred for work performed to a date bear the estimated cost to the contract cost, survey of the work performed. So there are a number of methods to be applied for that. So expected loss on a construction contract should be recognized and expense as soon as the such loss is probable. So when we know that this loss has already incurred, then that should be recognized immediately. There are certain disclosure requirements regarding that: amount of contract revenue recognized, how much it is recognized, what method you have used to measure the revenue, what method used to determine the stage of completion for contracts in progress at the balance sheet date, that is statement of financial position, aggregate cost incurred and recognized profit, amount of advances received, amount of retentions, and for presentation, gross amount due from the customer for the contract work should be shown as an asset, and the gross amount due to customer for construction work should be shown as liability. See, these are the disclosure requirements regarding the construction contracts. Third important issue, which is related with the contemporary issues of financial reporting, is the treatment of the financial instruments. Basically, financial instrument is a contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. For example, if you make a payment to buy an equity shares, definitely this is a contract between you and the company. So after this, and financial asset is arrived, and a person who buys the equity share, this is a financial asset for him, and the company who offer these shares or giving these shares, this is a liability for them. So equity instrument arise out of that. This is called a financial instrument. So it's basically a contract between two. For example, if you buy a debenture of a company, this is an asset for you. This is a financial instrument, but this is a liability for the company who is giving you this debenture document. So IAS 32 is basically international accounting standard which outlines the accounting requirements for the presentation of the financial statements, particularly as the classification of such instrument into financial assets, financial liabilities, and equity instruments. This standard also provides guidance on the classification of the related interest, dividend, gains, losses, and when financial assets and financial liabilities can offset to each other. These are the requirements which are governed under the IAS 32. The objective of IAS 32 is to establish principles of presenting financial instruments as a liability or equity and offsetting financial assets and liabilities. IAS 32 address this in a number of ways. Number one, it clarifies the classification of the financial instrument issued by entity as a liability or equity. It prescribes the accounting for treasury shares, for example, entities own repurchase shares. When you issue the share, but you buy back these shares, that is called treasury shares. So prescribing a strict condition under which assets and liability may offset in the balance sheet. For example, you have issued certain shares, but after this is shown as a liability side, but after some time you buy back these shares. How to offset these shares? Because you have purchased your own shares, Similarly, sometimes you purchase your own debentures from the market to offset it. So this IAS 32 prescribe the criteria how to follow all these things, how to offset in the balance sheet. The scope of IAS 32 applies in presenting and disclosing information from all kind of financial instrument, but certain exceptions. For example, interest in subsidiaries, associates, and joint venture, which is covered under IAS 27. Consolidated and separate financial statement, this is covered under IAS 28. Similarly, investment in associate, IAS 31. Similarly, annual periods beginning on or after 1st January, IFRS 10 for consolidated financial statements. So whatever, for example, employer rights and obligation, they are covered under IAS 19, insurance contracts, IFRS 4. So these are the certain exceptions where separate accounting standards are there for dealing with these kind of issues, which may be related to the financial instruments. So at that place, we will not be applying the IAS 32. Otherwise, we will be applying the IAS 32. So now this IAS 32 has defined the financial asset. What is financial asset? Any asset that is either cash or an equity instrument of another entity, or it may be a contractual right between the two parties. For example, to receive cash or another financial assets from the same entity. For example, you may have purchased debenture. One option is you will redeem that debenture and get a cash. Another option is you will get another kind of debenture in place of the redemption of the debentures in cash. Or you may receive equity shares in place of redemption of a debenture. So it may be to exchange financial assets or financial asset as entity with another entity under conditions that are potentially favorable to the entity. Or it may be a contract that will or may be settled in the entity's own equity instruments. As I have already said, that you may have preference shares, but when you redeem the preference share, you may issue them equity shares or you may issue them debentures. So basically, financial instruments are non-derivative for which the entity is or may be obliged to receive a variable number of entities' own equity instruments. So, or it may be a derivative that will or may be settled other by the exchange of fixed amount of cash or another financial assets for a fixed number of entities' own equity instrument. For this purpose, the entity's own equity instrument do not include instruments that are themselves contract for the future receipts or delivery for the entity's own equity instruments. So it may be putable instruments classified as equity or certain liabilities arising on liquidation classified by the IAS 32 as equity instruments. Similarly, the financial liability is liability that is a contractual obligation either to deliver cash or another financial assets to another entity or to exchange financial assets or financial liabilities with other entities under the condition that are potentially unfavorable to the entity. So a contract that will or may be settled in entity's own equity instrument and is similarly as we have discussed in the asset. So if one is a liability for one, another is an asset for that. So the definition is almost same. Now the question we have used the term derivative. A derivative is basically a financial security with a value that is relied upon or derived from the underlying asset or group of assets, a benchmark. For example, if you have a debenture and you may have heard about gold bonds, that means the value of the debt bonds is fixed or related with the gold. So whatever the value of the gold will be there at that time, at that point of time, so that will be realized from the value will be realized from the value of the gold. So derivative itself is a contract between two or more parties, and the derivative derive its price from the fluctuations in the underlying asset, and the underlying asset is gold. The most common underlying asset for derivative are stocks. It may be stocks, it may be bonds, it may be commodities, it may be currencies, it may be interest rate, it may be market indexes. These are commonly purchased through brokerages. So basically, under derivative, the value of the instrument is dependent or derived from the underlying asset, or it may be a group of asset or a benchmark like interest rate, market indexes, etc. Similarly, I have used the term putable instrument. Basically, putable instrument is a financial instrument that gives the holder the right to put the instrument back to the issuer Either for cash, putable mean, for example, you may have a certain kind of bonds that at any time you can put this to the issuer and get the cash, or you may get another financial asset, or is automatically put back to the issuer on occurrence of uncertain future events or the death or the retirements of the instrument holder. So it may be revoked at occurrence of some event or occurrence of certain conditions that you have to pay back to the instrument issuer, who has to pay back to the holder the amount or the another kind of financial asset in return to that. That is called putable financial instrument. So under financial instrument, no requirement is for disclosure, but disclosure requirements are given in IFRS 7 or in the IAS 1 or IAS 24, that how this value has been arrived at, and what is the criteria to pay back, what are the various instruments which are derivatives, that means on what kind of assets the value is dependent upon. All these things has to be disclosed in this. Another important issue is regarding the accounting for income taxes. That is dealt with the IAS 12, because every business has to pay the income tax. And similarly, every asset or a liability which you incur in the organization, that underlies certain kind of tax obligations. So IAS 2 prescribe the accounting treatment for income taxes, and income taxes include all domestic and foreign taxes. It may be payable in India, it may be payable in abroad, that are based on taxable profits. Current tax for current and prior period, and the extent to it is unpaid. So if it is unpaid, it is recognized as a liability. If the overpayment is there, that is recognized an asset. So how this liability or asset has been calculated, and how this overpayment has been made, and how this, if underpayment is made, then how this is treated as a liability, all these things are explained under IAS 2 12, sorry. So IAS 12, that is related with the income taxes, implements a so-called comprehensive balance sheet method of accounting for income taxes, which recognizes both the current taxes consequences of transactions. So every transaction which will happen, that will arrive certain kind of tax obligation. Every event which will occur in the organization, that will arrive with the certain kind of tax liabilities and tax consideration. So everything, even if the future recovery is going to be made by the business, that is also related with some kind of carrying amount of assets and liabilities in the form of tax payments. So differences between the carrying amount, for example, if you have made certain overpayments, then this is your asset. If you have made certain underpayments, so this is your liability. So how you are going to create the difference of tax break of assets and liabilities and carried forward the tax losses and credits, you have to recognize in your statement of financial position as well as in the statement of comprehensive income, with limited exception, for example, deferred tax liabilities or deferred tax asset, with the latter being subject to probable profit test. So these are the things which are explained in the IAS 12. The objective of IAS 12 is to prescribe the accounting treatment for income taxes. And for meeting this objective, IAS 2 notes the following. Number one, it is inherent in the recognition of asset or liability that asset or liability will be recovered or settled. If you are going to get the refund of the taxes, only then that asset, income tax will be treated as asset. But if you are not going to get the refund of it, is unprobable that then not recognize this. The recovery or settlement may give rise to some future tax consequences, which should be recognized at the same time as asset or liabilities. If it is probable that you will be having certain kind of liabilities for tax payments, that would be immediately recognized as a liability, tax liability. So if it is going to recover something from the as refund, that should be treated as asset. So entity should account for tax consequences of all the transactions and other events in the same way it accounts the transactions for other kind of things. The presentation, current tax assets and current tax liabilities can be offset in the statement of financial position. If you have certain advances and if you have certain liabilities to pay, then you can offset it, and instead of showing both side, on the asset side also, on the liability side also, you can offset this. So deferred tax asset and deferred tax liabilities can also be offset in the statement of contribution if the entity has a legal right to settle current tax amounts. If it has no legal right to settle it, then you cannot offset it. The amount of tax expense related to profit or loss is required to be presented in the statement of profit or loss or statement of comprehensive income. So the tax effect of items included in the comprehensive income can either be shown net for each other, or you may, you if you have a liability or if you have a current asset also, either you can offset it, either you can show it separately. So this is up to you. So this is the presentation criteria. These are the things which you have to explain in the books of the accounts. There are certain disclosure requirements which require the major components of the tax expense, current tax expense, how much there is, income is there, any adjustment of the tax prior period, amount of tax, deferred tax expenses, amount of tax expense, amount of benefit arising from previously unrecognized tax loss. If you have written down something, amount of tax expense relating to changes in accounting policies or correction of the errors, whatever has happened in the form of increase in the tax liabilities or decrease in the tax liability, that you have to disclose in the notes to the accounts. This is regarding the IAS 12, which relates to the income taxes. Similarly, there are certain further requirements that aggregate current tax liabilities and deferred tax liability need to explain. Tax relating to each component of the comprehensive income need to be explained. Change in the tax rate, what impact it has been there over the statement of comprehensive income. All these needs to be explained. Tax relating to discontinued operation need to be explained. Tax consequences of dividend declared need to be explained. So all these are the additional disclosure requirements. Next component of the financial reporting is the earning per share. So earning per share is very, very important aspect, because most of the prospective shareholder who want to buy the shares of the company or the present shareholder, they want to know the earning per share of the company. So there are two concepts of earning per share of the company. One is the basic earning per share, and second is diluted earning per share. So IAS 33, which is earning per share, set out how to calculate both basic earning per share as well as diluted earning per share. I'm using the word again and again, diluted, because one is that number of shares you have issued already, you have profit for the year, you can find out the earning per share. One is diluted, that means some share you are going to issue in future because of the redemption of preference share and giving them equity shares. Or for example, you may have issued shares in between the year, so it will be wrong if you take the total number of share for the whole year. So in that case, you have to calculate the diluted earning per share, which include the dilutive potential ordinary shares such as options and convertible instruments if they meet certain criteria. So objective of IAS 33 regarding the earning per share is that to prescribe principles for determining and presenting earning per share amount to improve performance comparison between different. So if everybody is calculating earning per share, basic earning per share or diluted earning per share on their own by using their own methodology, then the earning per share concept will not be comparable with the other company. So that's why the standard was needed, and IAS 33 prescribe all this thing. The scope. IAS 33 apply to all entities whose securities are publicly traded and they are in the process of issuing securities to the public. Other entities that choose to present earning per share must also comply with the requirement of the IAS 33. So if both parent and consolidated financial statement are presented in the single report, earning per share is required only for the consolidated statement. So in that case, you will be following only one. That is not needed that you must report the figures for parent company also and the holding company also. So there are certain concepts which are explained in the earning per share concept. That is, one is ordinary share, also known as common share or stock, an equity instrument that is subordinate all to the classes of the equity instruments. Similarly, we have potential ordinary share, a financial instrument or a contract that may entitle its holder to ordinary share. For example, you have issued debentures, which are convertible debentures. So in case of convertible debentures, so you may get the ordinary shares. You, in case of convertible preference share, you may get the ordinary share, you may, in case of share warrants, sometimes share equity shares are converted, a block of shares are converted into share warrant, but after that you get back equity shares. Share options are there, share rights are there, employee stock purchase plans are there, contractual rights to purchase these shares. So in these cases, these are the conditions which may arise, that you have to issue ordinary shares to all these holders. So that is give rise to the potential ordinary shares. What are the requirements of the IAS 33 regarding the earning per share? So any entity whose securities are publicly traded or that is in the process of public issuance must present the face of the statement of comprehensive income. They must disclose the basic as well as the diluted earning per share. For profit or loss from continued operation attributable to the ordinary shares, profit or loss attributable to the ordinary equity shareholder of the parent company for each class of ordinary share, that is has a different right to share in the profit for the period. If the entity present the components of the profit or loss in a separate income statement, it present earning per share only in the separate statement. So both basic and diluted earning per share must be presented with equal prominence for all the periods, and basic and diluted earning per share must be presented even if the amounts are negative. Even if the negative earning per share, that is the loss per share, should also be disclosed. It is not there that only when you have a profit you will calculate the basic earning per share or the diluted earning per share. Even then, in that case, you have to, in the case of losses also, loss per share need to be disclosed. So these are the certain requirements regarding the now what is by basic earning per share? Basic earning per share is calculated by dividing the profits or loss attributable to the ordinary equity shareholder of the parent company, that is the numerator, by the weighted average number of ordinary shares outstanding during the period. For example, you have 100 share for 3 months only. After that, the total shares becomes 200. So it means for 3 months you were having 100 shares, for 9 months you have 200 shares. So you will calculate the weighted number of ordinary share outstanding during the period, and the profit belonging to the equity shareholders for that period will be divided by this denominator. So the earning numerator, profit or loss from continuing operation, and net loss used for calculation should be after deducting all expenses including taxes, minority interest and preference dividend. So tax should be after preference dividend. So the denominator, that is how to calculate the number of shares, is calculated by adjusting the shares in the issue and the beginning of the period by the number of shares bought back or issued during the. So in whatever period in a 1 year, if at the end of the year you have 1000 shares, but for 3 months you were having 500 shares, for 3 months you were having 700 shares, for 3 months. So in this way we will calculate the weight, and weighted average number of shares will be used for the as a denominator. So contingently issued shares are included in the basic earning per share denominator when the contingency has been met. So if you have some contingency that after a period of time automatically debentures will be converted into shares. So when this is converted, only then the value will be included in the denominator. Second is diluted EPS. Diluted EPS is calculated by adjusting the earnings and number of shares for the effect of dilutive options and dilutive potential ordinary shares. For example, if you have a potentiality that after some period of time debentures will be converted into shares, preference share will be converted into shares. So you will calculate after dilution how much equity shares will be there, and you will be using that for calculating the diluted EPS. There are certain disclosure requirements in the EPS also. The amount used as a numerator, how this profit has been calculated, how the weight has been calculated, how the diluted number of shares has been calculated, how the weighted number of shares has been calculated. So all methodologies need to be explained in the disclosure part. Next important part is interim financial reporting. So interim financial reporting means, you know that basically every company prepare its annual reports at the end of the year. But now this is a time of information era, and everybody wants some interim reports also. Interim reports may be a quarterly reports, it may be a half yearly reports, it may be the monthly report, etc. So IAS 34 prescribe the minimum requirements if you have to present the interim financial report applies when interim reports are prepared, and without mandating when entity should prepare such a report. It is not mandatory for the companies to prepare the interim reports, but sometimes stakeholders demand that you must present the interim reports. But if the company is providing interim financial reports, then they should meet minimum criteria as per the IAS 34. So permitting less information to be provided, it provide the option to the company that instead of providing the detailed information as annual report, you may provide abridged information, less information, but with certain cautions. This standard outline, this standard will tell you how to recognize how the things will be occurred in the statement of comprehensive income, statement of financial position, how you will measure it, what are the various disclosure requirements for the interim financial reports. So the objective of IAS 34 is to prescribe the minimum content of the interim financial reports and prescribe the principles for recognition and measurements in the financial statement presented for the interim period. So what is the interim period? A financial reporting period shorter than a full year. So it may be half yearly, it may be quarterly. So interim financial report, a financial report that contains either the complete or condensed set of financial statement for the interim period. So naturally, if you are using quarter, if you are using half year, then it is a interim period, not a full year period. So minimum content which is prescribed under the this standard IAS 34 is the condensed for the minimum components of specified interim reports are you have to provide condensed balance sheet, statement of financial, no detailed explanation is required, only the format is required to be fulfilled. For example, you have to similarly provide a condensed statement of changes in equity, condensed statement of cash flows, and selected explanatory notes. No detailing is not required, but this is just a summary of the whatever has happened during that particular period, and an abridged form is provided in this interim report. Next very important component, or you may say contemporary issue in financial reporting, is the effect of changes in foreign exchange rate. Most of the companies are working at a global level, and they are working in a different currencies, but they are preparing, if they are in India, they are preparing their accounts according to the rupee. But if when they have to list their shares in the international market, they have to prepare their financial statements in dollars or in euros or in, for example, pounds, etc. So IAS 21 will explain the effect of changes in foreign exchange rates, and it outline how to account for foreign currency transactions and operations in financial statement, and also how to translate financial statements into a presentation currency. For example, you are presenting your books of accounts in the home currency, but for listing it, you have to convert this financial statement in the presentation currency of another country. So definitely with this, your financial transactions, if you convert it in the dollars or in euros or in pounds, definitely some kind of valuation will be required, some kind of losses because of change in the currency rates will occur. So entity is required to determine the functional currency for each of your operators based on the primary economic environment in which it operates, and generally record foreign currency transaction using the spot conversion rate to functional currency on the date of transaction. So IAS 21 explain the effect of changes in foreign exchange rate. So if the foreign exchange rate change, for example, the value of the rupee will be deteriorated if the value of the dollar is increased. So definitely what kind of this impact on your financial statement is there, that you have to explain. So the objective of IAS 21 is to prescribe how to include foreign currency transactions and foreign currency operations in the financial statement of an entity, and how to translate financial statement into presentation currency. So the principal issues are which exchange rate to use, how to report the effect of changes in the exchange rates in the financial statement. This is the objective of the IAS 21. So there are certain concepts which are explained in the IAS 21. For example, functional currency, the currency of a primary economic environment in which the company operates or the entity operates. For example, if you are in India, your economic environment is in India, and you will be preparing it in the rupees. Presentation currency, the currency in which the financial statement are presented For example, if you are in India, but you have to make the presentation in the UK currency, definitely that will be a presentation currency. Exchange rate difference, the difference resulting from translating a given number of units of one currency into another currency at different exchange rates. So foreign operation, a subsidiary, associate, joint venture, branch whose activities are based in a country or currency other than that of the recognizing entity. So there are certain disclosure requirements which are required for this. The amount of exchange differences recognized in the profit or loss, excluding differences on financial instruments for which we have IAS 39. The net exchange differences recognized in other comprehensive income and accumulated in the separate component of equity and reconciliation of the amount of such exchange differences. When the presentation currency is different from functional currency, disclose the fact that with the functional currency and the reason for using presentation currency. Why these are two different currencies in case of functional as well as the presentation. So, but a change in the functional currency of either the reporting entity or a significant foreign operation or the reason for this, why you are using the functional currency of other country. So, this significant reason you have to explain in the notes to the accounts. So these were certain issues which were the contemporary issues. One another issue I would like to discuss with you is the segment reporting. Segment reporting, and sometime you have to explain all this in your. Let me show you screen again. So segment reporting basically arise when you are required to prepare financial statement by business or geographical area. For example, you have 10 units of your company and they are spread over different segments or different geographical areas. Then it is imperative and required that you must explain your position segment wise. So IAS 14 is dealing with this. So it requires disclosure for primary and secondary segment reporting formats, with the primary format based on whether the entity's risk and returns are affected predominantly by the products and services it produces or by the fact that it operates in different geographical areas. Sometimes you have the segments, product wise segment is there, geographical wise segment is there. So this IAS 14 require disclosure. If you have a you may divide it a primary segment or a secondary segment, so different formats are there. So you have to explain how each segment is contributing to the main institution or a main company, and if whether the loss of one segment is covered from the other segment. So all these informations are required under IAS 14. The objective of IAS 14 is to establish principles for reporting financial information by line of business or by geographical area. So segments may be by the geographical demarcation, or it may be by the product line demarcation. For example, if the company has seven of Hindustan Unilever Limited is now, they have different segments line of business. So their businesses line of segments may be through the different kind of product line. Similarly, if they are geographically separated, you may region wise you may explain the segment. So it applies to the entities whose equity or debts are publicly traded and to entities in the process of issuing. So if their shares are publicly traded, then you have to use the IAS 14 to explain all this. So in addition, any voluntarily providing segment information should be comply with the, it is not mandatory, this standard is not mandatory, but if your shares are publicly traded, your securities are publicly traded, then you have to explain your segment wise information. Otherwise you may give it voluntarily, but if you are giving it voluntarily, you have to comply with the IAS 40. So this I have already told you, this is applied by the entities who debt or equities are publicly traded and those who are in the process of issuing such securities to the public. If it is not, then you may not use it. But if you are providing segment wise information, segment information need not to be presented in separate financial statements. Or for example, parent, subsidiary, equity method or equity method joint venture that are presented in the same report as consolidated statement. So you have to give the segment wise information. It is not required that you must mention this is a parent company's profit or subsidiary company's profits or etc. So this standard has also defined what is business segment. Business segment is basically a component of an entity that provides a single product or service or a group of related products and services that is subject to risk and return that are different from all these other business segments. Geographical segments, a component of an entity that provide product and services with a particular economic environment that is subject to risk. So there are different regions in which you operate. Reportable segment is or geographical segment for which IAS 14 requires segment information to be reported. Segment revenue you have to explain, segment expenses you have to explain, you have to explain the interest, losses on sale of investments, losses on investment accounted by the equity method, income taxes, segment result you have to report, and segment assets and liabilities you have to. Here you need not to explain the information by this is the parent company's information, this is a holding company information, this is a subsidiary company information, but you have to explain all results segment wise, either geographical segment or business segment or reportable segment. So segment revenue and segment expenses you have to explain. So we have to identify the business and geographical segment. So entity must look into its organization structure and internal reporting system to identify reportable segments. So this will depend upon the company to company. So in a particular, IAS 14 presume that segmentation in internal financial reports prepared for the board of directors, chief executive officers should normally determine segments of external financial reporting also. So sometimes we generate the reports for internal purposes. Sometime the board of directors require that these are the bases on which you have to prepare the reports apart from the external reporting system. So in that case, the methodology which you use for internal reporting system also you must use also for external reporting system. So if internal segments are not along with the product size or geographical line, then disaggregation is possible. So geographical segmentation may be based either where assets are located or where customers are located. So that will depend upon case to case. So whichever basis is used, several items of data must be presented on the other basis if significantly different. So there may be primary and secondary segments. Which segments are reportable? These are the certain guidelines which are given under this, where assets are 10% or more of the total assets of all the segment that must be reported as a separate segment. So where 75% of the total condensed equity or revenue is included, that is also separately to be reported. So these are the certain guidelines which are given under the segment reporting. So these were the certain issues which I have discussed with you today. Some issues I will be discussing tomorrow also. So with this, the whole all the concepts will be covered. Whatever I have told you, I will be sending you this presentation also. Only this much amount of literature is required to be used by you in your answer books, whatever the replies to the questions you are going to write. Now you can on your videos for 5-10 minutes. You can have interaction. After that, we will meet tomorrow again on the same time. I'm going to share with you this presentation right now. The file has been sent to you, and I'm sending another file. Check your chat box whether you have received this file. You may download it now. The file has been sent to you. Check your chat box. If you have received this file, you may write yes.
No, sir.
The file has been moved to you, but because you are operating from the mobile phone, so that's why it is not received by you. Okay, I will send in the Google Classroom also. All of you are operating from the mobile phone, that's why you are not receiving it. Otherwise, from my side, it has been sent to you. Check your chat box.